Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by JK. JK, how are you, mate?
Thanks, mate. How are you?
Yeah, not bad. Excited to get into another episode and where we're covering around FAQs or frequently asked questions. And today we're going to have a little bit of a flavour around things like interest rates, economic environments, market impacts from, government policy as well too, because it's really a hot topic at the moment, especially, with the Trump administration coming into power in the US. What does that mean? And also around kind of what's happening locally, especially with a, federal election this year as well too. So, JK, there's a bit going on.
Yep, there is.
Where you want to start?
Yeah, so first one to start off with is what's happening in the US around the tariffs. So I think we'll start with firstly just what are tariffs?
Yeah. It's interesting. He's come out and said around he wants to put tariffs on Mexico, wants to put tariffs on Canada, and wants to put tariffs on China. And he's put a pause on the Canadian and the Mexico ones at the moment because they're negotiating in regards to what they're going to do with the border and stuff like that. But the Chinese seems like that's rolling out. JK, what is a tariff?
Yeah, that's a good question. And I think the best way to sort of start to explain it is if you've got two people that are in business, so say me and you're in business and you're sending me all these leads and we've got an agreement that you send me your referrals, I send you my referrals. 12 months go by, you've sent me about 100 referrals, I've sent you 5. You're probably going to be like, well, this isn't fair because I'm giving you all this money and getting nothing in return. So you essentially just start trying to, charge me a fee for those referrals just so the arrangement starts to become a bit more fair on both ends. I'm winning and you're winning at the same time. Essentially, the reason why you'd impose a tariff is kind of the same reason behind that. So let's just say you've got two countries. You've got a country like America who's a net importer of goods, which essentially means they buy more from other countries than what they are sending out. And then you've got a country like China who's a net exporter. So they're essentially moving more goods overseas than what they're buying from other countries. So that's essentially the same arrangement where you've got someone like the US who's going, well, we're sending you all this business because of all these goods that we're importing, but we're not getting as much as in return out of that. So the idea behind the tariffs is you're essentially putting a tax on the goods that those countries are making and sending to you, just so you're getting a bit of benefit out of that.
And when you say benefit, obviously you're talking about the benefits of the revenue that you're getting from that. However, there's also the economic benefit to your country. There's obviously pros and cons around that's then going to help the businesses that are within your country compete with those international players, correct?
Correct. Because the other thing that it does is too, like if we take manufacturing, for example, if all of a sudden the cost to import something is more expensive, then it creates more of an incentive for people inside your own country to actually go make those goods themselves. So it encourages manufacturing or, whatever goods or service you're producing to actually happen in that country as opposed to trying to import it from overseas.
And we've got to be said that, Trump rolled this out around the steel industry in America when he was in his first term. And, the steel industry has really started to thrive back in America. And, that's really good because obviously it's stimulated jobs. However, tariffs are an inflationary play.
Correct.
So the consequence of, increased taxes and increased costs for the US citizens is around, that's driving up prices in both ends. So it's going to be interesting how that economically plays in there, but also what the rest of the world does about it, because that's going to cause, potentially cause global impacts, especially on things like investments, because it's going to be more expensive to be able to produce goods and services and stuff like that. And then what that means to things like the stock market in regards to profit margins of businesses, but also just in regards to like employment and stuff around the world as well too. So it's like short-term inflationary, potentially long-term deflationary in regards to restricting economic activity.
Correct.
But I think the premise in what he's trying to do actually is this kind of thing about looking after your own country first.
Correct, yeah. And that's what I was kind of going to say is it depends on what side of the fence you're on as well. Like if you're in America, you're probably going, well, this probably makes a lot of sense because, you know, we're, like I said, we're giving out all this business but not getting anything in return.
We're losing jobs to other countries as well too.
Correct, all that sort of thing. But then if you're a country like China, then you're probably going, well, hang on, this isn't right because, you know, we've got it good now and we don't want to be paying all this extra tax.
And it's interesting, like he's coming out with this policy at the same time he's coming out with like he wants to potentially drop income tax completely, move into a more consumption-based tax. And if you think about like a consumption-based tax here, you're thinking about GST, okay? Things like GST where you purchase things and you're paying it 10%. He's looking at abolishing that. Now, there's some significant savings for the American people. Once again, inflationary. You know, so it's very, very interesting, and we're keeping a close eye on this around what's going on in these tariffs and what it means. Typically, though, stocks and property are relatively good when it comes to real returns or inflationary environments, aren't they?
Yeah, correct. And I think, especially like with stocks, for example, like we always talk about, you know, when you're buying stocks or shares, you're buying a percentage ownership in a company. If they're essentially, you know, at the stage where, because the companies wake up every day to earn a profit. So at the end of the day, if there's less taxes being paid, then there's more money going around. So then there's more potential spending, which is kind of the idea behind these.
And also as a US company, your competitors internationally are more restricted than you are.
Correct. So at the same time, like, yes, inflation is an issue, but then also the profits should be going up at the same time. So it probably nets itself out a little bit as well. And that's why over the long term, things like stocks can actually be really good for weathering these storms. Yes, short term, there's going to be some headwinds, but over the long term, I think things should sort of balance out.
JK, do you see some of these policies being brought here? Do you think that do you reckon that there's I'm not going to say a movement, probably the wrong word is around, do you think that there's some merit in regards to Australia applying that here to improve the financial landscape for Australians? You know, and I know, and we're going to talk about this around the inflation rate getting to just in the healthy range. But, you know, there's still a lot of demand for employment here. There's still a sense of the construction industry being put under a lot of pressure, which is kind of the heartbeat of Australia. You know, manufacturing has moved overseas. We got natural resources here, but, you know, once again, I think it was the Gillard government that put the mining tax on miners as well, and then they moved offshore. Like, do you think that there's premise to start applying, I'm not necessarily those strategies exactly, but bringing some of those, maybe not tariff related stuff, but maybe around the income tax and stuff like that to Australia?
Yeah, I think I guess answer the first thing around tariffs and all that, I think there's a place, but probably not to the extent that the US is going, just because we're essentially a smaller fish in the ocean compared to what the US is. So
I think we're like 2% of the world economy, like to put in perspective, yeah?
Correct, yeah. So when they come along and sort of say, you know, hey, we're going to apply all these tariffs, well, they're one of the biggest customers of the world. So the world's kind of going to just, to a certain degree, just cop it. If we tried to do that in Australia, I don't think it's going to work to the same effect.
But the premise around trying to look after your country in regards to the economic,
100%.
I think, is something that needs to be had. And I think inflation is at the heartbeat, which one of the other questions we got, JK, is around, you know, RBA is going to meet 18th of Feb, I think it is, so a couple of weeks from now. And, you know, do they drop interest rates? And, you know, banks have come out, and two banks, I think it's NAB and Westpac, have already come out and started dropping their fixed rates. And so there's a clear indication from banks that they're going to apply that, obviously on what they believe that the RBA is going to come out and do. And so for mortgage holders, it's going to be a sign of relief that, finally there's interest rate cuts. So I think it will happen. Should it happen is another question. And, when we talk about this kind of inflation environment, it's really obliterating the middle class. What I grew up in and many people grew up with was most people averagely were the same. But the more debt that's come into the economy, the more inflation that has come into the economy, the rich are getting richer and the poor are getting poorer.
Correct.
And so my bigger concern, as bad as it sounds, is not your ability to repay your debt from an interest rate perspective, because in most cases you can adjust lifestyle and do certain things. It's inflation. Because if you think about 3% of your expenses going up each year versus 0.25% of your mortgage additionally up, the 3% of your total expenses is more than your 0.25
Correct.
of your debt repayment. So the other issue is that as a debt to income ratio, when it comes to the wealthy, it's not a restrictor on them in regards to cash flow.
Yep.
So I think if I was advising the government, it would be around utilising things like APRA as a tool to be able to restrict debt proportionally, because if we can kind of restrict debt, we can restrict the debt-fueled lifestyles, because those debt-fueled lifestyles, and what I mean by that is like you still go out in the city, you still go out to places, but everyone's at restaurants, at fancy places, there's bags and watches and things still being bought. Now, I know, that when we see people's finances that come to us, these are fueled by debt.
Absolutely.
So if we can restrict debt, and one of the things that I talked about, and this is not fully thought out, so please, this is not like my final recommendation, was around the ability to not extend the loan term of your home loan. And that is something that like APRA could do. So they could say like, you can change banks. You can go from Commonwealth to Westpac to whatever.
If you've got 27 years remaining, you refinance at 27 years left.
Correct. So you can take on a potentially additional debt with a longer term. However, the actual debt that you've got, let's say you borrowed 500, that 500 has to stay within that term, forcing people to then decrease those debt levels.
Yep.
So and obviously that's not the final solution, but these are tools that APRA could apply that could say, hey, listen, this is the way we're going to go about restricting the debt-fueled lifestyle, because that's my biggest concern. It's attacking inflation. It's hurting households. It's likely that 30, 40-year-olds that are stuck in this cycle find themselves, get to retirement, 60, 65, want to kind of stop work, and that forced savings of superannuation is then going to be sold down to pay down debt. Because they've taken so much from their future you to pay for their current you.
Correct. And like you could get a 30-year loan at 45, access your superannuation at 65. So you've got, the superannuation money to pay down the 10 years left that's on the debt, and then you're kind of left with nothing.
Yeah, and I think that there's merit to kind of go down like a superannuation kind of condition release kind of scenario where, even though you've got like loan terms that can't be extended on existing debts, there's like 3 or 4 kind of conditions where you can apply for an extension, So that's what I'm saying. It doesn't need to be, it's not like the final solution, but we need to start looking outside of the, of monetary policy. And look to fiscal policy. And this is where I found that this government's really lacked in regards to, I would have loved to see in this inflationary fight more from the government thinking outside the box in regards to restricting inflation, because it's inflation that is hurting households. Now, it's not hurting the wealthy. We just talked about before, like inflationary, like stocks love inflation. Property loves inflation. Well, guess who has those assets? The wealthy. So this is something that needs to be thought of. It's one of the standards that the government needs to apply around the economic prosperity of the country and the standard of living around for Australians. And one of them is around the equal distribution of income. And it's these policies that previous governments have implemented that have done really good jobs. We talk about Paul Keating really being, a really forward-thinking prime minister who came from kind of Treasury. He did some really, really great things that the Howard and Costello government kind of took on that mantle and continued to kind of play out. We've lost that economic thinking. And I can see that in the US and I can see in other countries, they're now looking to leaders who have economic knowledge, expert knowledge in regards to how they play things out. So, economy is not everything when you come to choosing governments and what that applies, but, the financial well-being of your country is one of the main things that you need to be looking at, obviously coupled with things like health and safety and stuff like that. That goes without saying, but it's a big, big piece in regards to the way that we get around this inflationary fight. Go back to interest rates. I think there's so much pressure on the RBA that they're going to drop it.
Yeah.
What's your thoughts?
I wouldn't be surprised if they drop it, but I think like we sort of alluded to earlier, it makes sense if they probably don't drop it just because the whole time they've spoken about getting inflation within the 2 to 3% range and that's their number one priority. And now all of a sudden it's like, well, we're in that 2 to 3% range. If we drop the rates, we run the risk of then going back out of that 2 to 3% range and then having all these issues again. The other thing that also makes it more interesting is that RBA is not meeting monthly anymore. So they've kind of got to make a call on what they anticipate might happen in 2 months' time. So they're kind of trying to catch a falling knife a little bit as well because they don't have that frequent sort of meeting to assess the most recent data. They've kind of got to go, well, what do we think is going to happen in the next 3 months? And in 3 months' time might be too late to make the call. So we've got to make the call now based on what we think is going to happen.
So they've got to have more forecasting and the ability. So you're on the RBA board. What are you wanting to see? What data points are you looking at to say I feel comfortable to drop?
Well, you're probably wanting to see inflation tapering off.
Yeah. And when you say tapering off, like, are we talking about like ones or like negative?
So I'm sort of talking more that range is to say, well, if we're falling back into that 2 to 3% range, you want to see, a tapering off in the sense that
stabilizing.
We're stabilizing in that 2 to 3% range because if we're starting to fall too far down, then and we're going to go below that 2 to 3% range, then yes, increase rates because drop rates because you want to bring that back within the 2 to 3% range.
It's very interesting, JK, because when you talk about getting below that range, it also means that that interest. So we're in a deflationary environment. Then, there's argument from economic leaders that things need to get deflationary.
Yeah.
So it's an aspect of like even if it went below that range at 1.5, say, you got the ability to then go bang and then drop interest rates at a much more aggressive rate. Okay. So it's around, they talked about soft landing and hard landing and stuff like that. It depends on how aggressive and how quickly they move.
Correct.
When you go back to those meetings being pushed out, they probably can't be as aggressive as they want to be.
Correct. And I think the other thing is too, there's value in having that bigger lever to pull. So if they start dropping rates now, and then we have an issue like we did with COVID, there's actually then they've got less capacity to drop rates even more to try stimulate the economy again. So I think there's value in having not really high interest rates, but just making sure they've always got something left in the tank to then be able to stimulate the economy if they need to.
Yeah, it's very interesting. Very interesting. I think the other indicator, before we get on to the next question, that I'd like to see is around unemployment. Unemployment is relative to where I think it needs to be. And once again, this is going to be quite controversial because people don't want to hear this as much as I'm saying kind of hold rates, not kind of, is around, I don't see unemployment where it needs to be. I think it needs to increase more. And I think that will create, when unemployment goes up, it creates more vacancies.
Yeah.
Creates more...
creates more efficiency as well.
Creates more efficiency. And I think in Australia, we've got a productivity issue.
Yeah, exactly.
So if we can... And actually, before I get into that, and I think it's the numbers also being pushed up, from the immigration post-COVID. And so you've got this kind of mass demand. So all in all, I kind of want to see unemployment tick up a little bit, probably more than where it is right now. I want to see inflation come down a little bit more before I pull the trigger. And I know it's a bit more of an aggressive approach, but I think we've got enough in the tank to go from where we are now in the cash rate to where we need to get to. And I think we've seen that QE, which is quantitative easing, you can do it to stimulate an economy. If they shut down an economy in COVID and re-kicked it on, they can use it if they need to use it.
Yeah, correct. And I'm glad you brought up that productivity point as well, because if we look at an economy where there's no net, like the population staying the same, the only way that economy grows in real terms, and what I mean by real terms is if the GDP, so how much dollars that country is producing,
The gross domestic product.
correct, grows by say 5%, and your inflation's at 5%, well, in real terms, that country's not actually growing. So it's really only productivity or an increase in productivity that's able to have a country outputting more and actually grow in what we call real terms, unless you've got that migration coming in. So it's really important.
It's interesting you're talking about this, because I think another one that, it would be valid to mention was one of the things that Trump did when bringing in Elon Musk was to put him at like the Department of Government Efficiency.
Yeah.
And the big thing that he realizes is that a part of GDP, a part of inflationary pressures is government spending. So if you're unnecessarily spending money into, you're putting fuel on the fire of inflation.
Correct.
And it was interesting that we're in an election year, so kind of Dutton's kind of putting in his cabinet, and there's a Department of Government Efficiency. And, we're talking about before, like what policies get done overseas and how that's kind of coming in. Dutton's looking at that going, yeah, well, that's a way that I can fight inflation that doesn't necessarily hurt. And it doesn't need to be public sector people losing their jobs.
Correct.
Doesn't need to be that. There is a lot of government projects that start and don't finish, for example.
Correct.
There's a lot of unnecessary spending that isn't absolutely crucial.
Yeah, or even just projects that just ended up being more expensive than what they initially thought they were going to be.
Correct. And so being more useful in your time, proper financial planning and execution when it comes to the government, that's going to also help inflation.
Yeah, correct.
Yeah? We'll move on to the next question, JK, because I know we've covered a fair bit.
Yeah, we have. The next one is just around, so you've got property, stocks, share markets, crypto, all at all-time highs. What's your kind of thoughts around that? How does that impact people's, planning? Should they be buying? Should they be selling? Should they be doing?
Yeah, it's interesting. I think there's a combination of what's going on at the moment. Like, obviously, we've been talking about inflation, assets like stocks and property love it. Also, you've got the couple of accessibility to debt. Now, there's also this kind of movement where I see more people lacking delayed gratification. They want instant gratification. So I am seeing a lot of what I would call dumb money in the markets. People buying property when they shouldn't. I was speaking to a prospective client earlier this week. She literally said she bought her investment property on the way home from work. She saw a sign, thought it was a good idea, and bought it.
Wow.
Yeah, you say G because you know the process of making one big decision like that in regards to buying a property. And she then bought that one and then 6 months later bought another one. And so it's this, and I asked her around why her decisions were around this. And she's like, I've got 10 years until I want to retire. And she doesn't need to retire in 10 years. That's her fixation in her head that she wants that. And rightly so if that's what she wants. But it's just around, I want to buy property. And, I've talked about this previously. There's just so many property spruikers and advertisements around get rich quick kind of schemes around property, which is this huge demand. This goes the same in crypto. My mates earned a ton of money. They won't tell you about the losers. They'll tell you about the winners. So you get this bit of FOMO that's happening. Yeah. But also there's this sense of this last ditch effort that I'm talking about. And what I mean by that is like when you're playing poker, and you feel like you're losing, it's like you get to the point where you're just like, you know what, stuff it. all chips in. I'm seeing that happen more than more, where they're feeling this pressure. I've tried the slow way. The tortoise isn't winning. My friends are the hares and they're streaks ahead. I'm going all chips in, which concerns me because when you think about markets, there's this cycle and it's this emotional roller coaster.
Yep.
And it's around the roller coaster of this euphoric dumb money where
That's the top of the cycle.
We saw what DeepSeek did to to NVIDIA, NVIDIA. You saw how markets pulled back very quickly in regards to that. So it's showing me that the market in the stock market is very sensitive. I think might be 2 trillion. I'm going to get the number right. Anyway, large amount of money in regards to the crypto market fell off recently. It was the biggest pullback in a few days.
Yeah.
So markets are very volatile, very sensitive. Yeah. And obviously if we zoom out, and we're also seeing in the property market some cooling. Well, people are now putting properties on the market. We're getting much more supply come in, more supply, less demand, the ability not to borrow more. We're seeing and governments also being restrictive now.
Yep.
You know, this is the playbook for a downturn. You know, problem is you don't know when that downturn is going to happen.
Correct.
And a lot of people try and time the market. You know, I know a lot of people that, you know, are not clients of ours that are, you know, out of the market at the moment. They're like, I've had too much. I'm taking my chips off the table. And that's okay. But just remember when are you going to enter back in? And I think it was you, JK, was speaking about like just missing out on the first 10 days of a bounce back. And they usually happen at the bottom of a market. You know, the compounding effect of just staying invested in rather than trying to time the market is huge.
Correct.
And so all three, share market, property, crypto, there's a lot of signals that are saying that they're at all-time highs and there's due for a correction.
Correct.
Are we pulling all of our clients' money out of these assets? No. And I think the biggest thing is to understand that the money for our clients are only in stocks and property because we don't invest in crypto for our clients. It's there for the long-term goals that we're trying to achieve.
Correct.
So the money is always set up not only in line with what they can tolerate and what's needed from a risk perspective, but it's also very much the time horizon in which that money needs to be invested in. So even if markets pulled back, they went through a 3-year downturn, 5-year downturn, we've got the short-term bucket sorted out, which has the stability to kind of get them through. We've got that income bucket, which is going to be that kind of 3-year to 7-year money, even 3 years to 7 to 10-year money. And in fact, actually, when markets do downturn, we now get these asset prices that are much more fair value.
Correct.
And so when we're looking at then the overall picture in regards to the strategic asset allocation that we need them to be to achieve their goals, what I mean by that, there's a certain level of risk that our clients need to take to achieve their goals and aspirations because we want to manage the risks and then the returns will speak for themselves, is around when then markets pull back, it's an opportunity for us to then top up those growth assets.
Correct.
But in line with the plan. Not around, hey, it's a beautiful day outside, I think that we should invest. Yeah,
Correct.
It needs to be strategic. So to answer your question, where I think they're at, in the economic kind of clock, you know, we're right up there in regards to, you know, there's a lot of euphoria going on at the moment.
Yeah, correct. And I guess one of the other things is too, like you mentioned around, you know, we're obviously not telling our clients to sell because we try not to sell assets, and also the timing of this is really hard to get right. If you're accumulating, what should you be doing? Like, should you be slowing down what you're putting in? Should you be having enough buffers to then take opportunities? What's that sort of look like?
Great question. It's around just like going back to your time horizon, going back to your goals and aspirations. So you could find yourself in a situation where you haven't adjusted your plan and you're buying these assets at a more expensive level. You're actually, your asset values of, let's say, the amount that you need of stocks and property in regards to the strategic asset allocation that you need to achieve your goals, it would potentially be outweighted if it wasn't adjusted in favor of those assets. Meaning, let's say your asset allocation was 50% in defensive assets, 50% in growth assets. Cash, though it's been giving us a decent interest rate overall in comparison to the say S&P 500, I think the S&P 500 over the last 2 years, I think it's grown by 40%, to put it in perspective. So if you haven't adjusted in the last 2 years, you're no longer at 50-50. You might be at 70% growth assets, 30% on defensive assets.
Correct.
So in that perspective, we need to look at strategies around getting it back to that strategic level, because it's that strategic level which we want to kind of target at all times to get to where we need to get to. So, in that case, there's kind of two things that we may do. We may look at the stock portfolio and first and foremost, rather than maybe dividends reinvesting, get those dividends putting into the cash account. Also, if we're directing things like, regular savings plans or, contributions, we might direct them to defensive assets to get that weighting happening. Obviously, the third part of that is trimming down your profits that you've earned on those assets to then get back to those levels. Obviously, we're very mindful when we sell. We're triggering off capital gains tax in most cases. So mitigating that's very important.
Yeah, correct.
And so, but we also don't want to make knee-jerk reactions. I know me and you are working with a client at the moment that's about 5% out of weight, more growth than defensive. We'll tolerate probably up around a 10% movement out of that kind of range before we start to sell.
Correct.
We'll use the other measures first to kind of pull them back in line. Because we're not trying to time the market here.
Correct.
You can see this is a predetermined strategy based on their goals and aspirations and time horizons and risk profile to achieve their goals. And it goes reverse. So when markets are down, going in a downturn and that growth portfolio is flipped, rather than it being 70-30 in favor of growth assets, it's now 70% in defensive assets. We want to buy those assets in the growth portion, and they just happen to be cheaper at that time.
Correct. And this also sort of gets into one of the other questions that we've been getting a lot lately, is around, should I be allocating towards debt more, or should I be allocating towards my investments? And at the moment, just because of where the market is where it is, where interest rates where they are, it's not that we're not doing anything towards the investments, but just from a risk perspective, and this is the biggest one when it comes to investing, is managing the risk, not managing the return, is it does make a lot of sense to put your money towards your debt, because you're getting essentially a high guaranteed risk-free rate of return. However, when this correction does happen, and we don't know when, but it will happen at some point, is all of a sudden, because the equities are now cheaper, the risk in investing those equities is actually less. And that's when it starts to make more sense to then channel your surplus cash flow. Instead of going towards the debt, you're going more towards the investments.
And what I want you to see is, like, when we're managing money and when we're building people's financial plans, there's a major, major focus on managing risk. We obviously have talked on previous episodes around who you need to become behaviorally and the habits that we try and teach you and the education around that. But managing that risk is very, very important. And we've covered a bit today, JK, in regards to inflation risk and geopolitical risk and all of these other risks that come in regards to achieving ultimately what people come to do is financial freedom and beyond. But, I want everyone to realize that if you're not looking at any of this, you're putting yourself further and further and further behind the people that are actually professionally looking at this. We do not have a crystal ball. We do not know when markets are going to go down or markets are going to go up. But by applying these proven, tested, robust frameworks that are not just the Thriving Wealth Way, but also taught by some of the greatest people in investment history, like Benjamin Graham and Warren Buffett and Jack Bogle, the founder of Vanguard. And once applying those philosophies in regards to, I have seen the results that's happened to our clients in regards to not only sleeping better at night, but also achieving their goals and aspirations that they've gone out to achieve. So hopefully today's been very, very insightful. It's been really, really well received, these frequently asked questions. On social media, I've put a shout out for people to drop us any questions as well too that they may want answered. So thank you for the people that did give us these questions. And till next time, thank you very much. And be sure to click and subscribe on YouTube and also on our main platforms as well. Thanks, JK.
Thanks
everyone.
Thanks, everyone.